Alright, the topic of this video is stock versus options. The idea behind this video is to help you decide whether you want to trade with stock or trade with options. For many of you, the answer is simple. I'm going to trade with stock because I already have a stock account open. I know how to buy stock. I know how to sell stock. It's a simple process for me. Why even bother learning about options? Well, options are beneficial in two areas where stock is not. And those two areas are flexibility and profitability. Now, I'm not going to preach about why options are better than stock because they're not. It's really a conditional situation dependent on your risk tolerance and the amount of money in your account and whether you even need that type of flexibility that options offer. A lot of people are fine with a simple buy stock, sell stock strategy. However, that strategy does limit you to stock that's going to rise. And if we are in a bear market, like the 2008 crash, where pretty much every stock goes down, that strategy is not going to work for you. So I'm just going to outline real quickly what the benefits of each are. And before I do that, let me just give a quick recap of what stock and options are. Stock is a right to a portion of a company. Basically, a company that goes public issues shares of stock. The stock is now kind of called outstanding stock because it is outstanding, not because it's great. The outstanding stock is held by people who want it. It's sold by people who don't want it and bought by people who want to obtain it. So there's this market out there, and like eBay, kind of like Amazon. There's this market out there, people buying and selling stock. That's how stock works. What a lot of people don't know about their stock account is that they can also request permission to short stock, which essentially means that you are selling the stock before you even have it. You are selling the stock with the promise to buy it back later. Your idea behind this type of trade is to profit from a stock that's going to fall. So you buy it back when it's 10 bucks, but you sold it when it was 20 bucks. That's the idea there. So yes, stock can help you profit from using stock as your strategy can help you profit from a stock price is rising or a stock price is falling, assuming that you're using both buying and shorting strategies. Options is unrelated to stock. Options, when you buy or sell an let's talk about buying first. When you buy an option, you're basically betting on the stock. It really is more like a bet than anything else. One of the huge differences between stock and options is that stock, like I said, is issued by a company and then it has its own market. However, options are just created out of thin air. You could create an option right now and sell it to me for money that you get immediately. And an option is simply a contract. It's a contract that solidifies our bet. So let's say we're looking at Google stock right now. And I believe it's going to go up. You don't believe it's going to go up. I buy your options contract from you. I'll give you $100. I'm saying that Google stock's going up. If it goes up, every $1 it goes up, you owe me $100. So if it goes up $2, then I'm going to get $200 out of this bet. However, if it stays where it is, or you're drinking a beer, so yeah, very professional. If the stock stays where it is, or if it falls, you keep that money I gave you. So you keep the $100 I just gave you. Now, that makes a lot of sense if you just want to create income based on stupid people like me who think Google's going to go up, right? That's one option with options. The other option with options is to be me, to recognize that Google's going to go up and buy an option from a stupid guy who's going to write the option. So that's really how options work. betting or gambling. Anybody can do it. The market for options is essentially infinite, whereas stock is limited. Once you understand the inherent differences between what stock is and what options are, then you can start to analyze which one's better. And the three areas we're going to analyze are risk, profitability, and flexibility. Risk. For risk, stock, essentially, at the very fundamental level, stock is more or less risk-free. Because when you buy stock, you have something tangible. You own a piece of the company. The stock will only go up, or only go down, or only stay the same in value over time. Time doesn't really matter. What matters is how investors look at that company that issued the stock. It's that simple. So the risk is that the company, if you buy the stock, the risk is that the company's value goes down, the company goes bankrupt. That's pretty much it. Shorting stock has infinite risk. If you short stock, if you sell the stock at 20 bucks and tomorrow the company that owns the stock, the company that issued the stock, discovers a cure for cancer and the stock price goes up to $1 million, well, I hope you didn't sell 1 million shares because now you owe $1 million times $1 million. And you're fucked. So, if you're only buying stock, your risk is quite limited. If you are buying and shorting stock, you have infinite risk. For options, on the other hand, your risk is also possibly limited and possibly infinite, dependent on your strategies. If you are only buying options, whether they be call options, which is a set of options that assumes the stock will go up, that's your bet, or put options, which is your bet that the stock price is going to go down. If you're buying those types of options, your risk is limited to the money you spend on those options, just like it is for stock. The main difference, though, here is that you're actually less risky as an options buyer than as a stock buyer, simply because options cost less than stock. When you buy stock, if you buy 100 shares of stock at $20, you're going to be spending $2,000. If you buy 100 shares of stock, if you buy an option that is equal to 100 shares of stock at $20, you're really only be paying about $200. You're paying a very, very small ratio of what you would pay had you bought the stock instead of the option. So actually, if you're just a buyer of options, you have less risk. However, if you are a writer or a seller of options, you have a large amount of risk, similar to that of people shorting the stock. So again, it depends on what strategy you're using. That's going to determine what level of risk you're taking on. So what I recommend is, if you are of low risk tolerance and you have a lot of money, go with stock. Because stock doesn't depreciate in value over time, unlike options. Yes, I didn't mention this, I'm sorry. Options depreciate over time. Why? Because they have expiration dates. When you buy an option, you have the choice of many expiration dates from like a week to a couple years. If you're buying an option that expires tomorrow, for example, the stock must go up to where you think it's going to go up tomorrow. Otherwise, your option is no good. So the money you spent on the option just goes away because the option's expired. You can't do anything with it. Stock, on the other hand, doesn't expire. So here's my main recommendation. If you have a low risk tolerance and a lot of money, buy stock. It doesn't have an expiration date. You can also get dividends from some stock. So holding on to the stock, even if the stock doesn't go up, it will just stay the same, will also allow you to profit. Whereas if you buy an option on a stock that stays the same, or making a bet on the stock and the stock price stays pretty much flat, you're going to be losing money over time because the option's value decreases with time. As it gets closer to the expiration date, the option's value decreases. Okay? If you have limited risk and limited money, you go with options because you're not going to be able to afford stock that moves up quickly or goes goes down quickly in terms of dollar value, because those types of stock are expensive per share. Stock like Apple, Facebook, even Yahoo, it's going to cost you like $30 a share. But for options, you can buy huge amounts. You can technically, you're going to get a position that's equal to huge amounts of shares, but with a lot less money. Okay, so that's the deal with the risk. Now let's move on to profitability. Like I said, you spend less money on options to get more shares of stock. That alone, which is called leverage, gets you more profitability if you're spending the same amount of money on stock and options. So if you're going to spend $2,000 on options on the stock Yahoo versus $2,000 buying the stock Yahoo, and Yahoo shoots up, we're assuming you're buying a call option, Yahoo shoots up like to $50. You're going to make more money had you bought options than you would had you bought the stock. If the stock shoots up from $25 to $50, you basically doubled what you spent. So your $2,000 is now $4,000. However, if the stock shoots up from $25 to $50, you're probably going to make, let me do a quick calculation, $25 to $50, so you make $250, I don't know, $25,000. The idea is, generally, if you buy an option, ideally, if the stock price behind the option goes up $100, you are going to, the stock price behind the option goes up $1, you're going to make $100 for each option you bought. So, let's do the calculation. I probably did it wrong. 2,500, correct. 2,500 bucks. You're gonna make 2,500 bucks for each option you buy. And if you're spending $2,000 to buy options on Yahoo, you're probably buying at least 10 options. So $2,500 times 10 is correct. I was correct. So you've made 25,000 bucks, whereas the person who bought stock only made 2,500 bucks. Okay, so that's the power of options. But that power comes with the trade-off of expiration dates and depreciation overall in value. So that's profitability. Another aspect of profitability, actually this moves on to flexibility. So flexibility versus simplicity. If you want simple strategies, if you don't want to think too hard, if you don't want to do too much research, if you don't have the time to play, even if you're swing trading, if you don't have the time to do analysis every day, stocks is probably better for you. However, if you want the flexibility of being able to profit via several different ways, you'll want to go with options, because you have the combination of writing calls, buying calls, writing puts, and selling puts, and you can do all of those at the same time on one stock. You're basically making several types of bets on one stock through clever manipulation. You can benefit through several different ways, one of which is very interesting in that you can benefit if the stock stays the same. So some option strategies have the assumption that the stock is going to stay the same. You use that strategy. If the stock really does stay flat, you profit. You profit more than if the stock would have gone up or gone down. And that kind of flexibility is something you cannot go with stocks, even if you're both buying and shorting. So overall, it comes down to risk, profitability, and flexibility. In terms of risk, you've got a lot of money with stock, and if you've got a lot of money and low risk with stock, you've got just a little bit of money and low risk, go with only buying options. And if you have high risk, regardless of your capital, go with many different option strategies, including writing options. For profitability, options would be the obvious answer. For simplicity, stock is the better choice. And for flexibility, options is the best choice. This is a decision you have to make on your own. I can't tell you what's right based on knowing nothing about you. But the idea here is, think about it. What are your goals as a trader? And based on those goals, what's going to be the better tool for you to trade. That's all I have to say. Market